In the grand vistas of the Teton Range, gathered among the crisp mountain air and whispering pines, some of the world's most powerful financial leaders confronted a new economic era taking shape. An era marked not by the specter of runaway inflation, that demon from the 1970s, but the subtler menace of economic fragility. The annual Jackson Hole Symposium, that Woodstock for monetary policy wonks, served as a pivot point. After years of furiously raising interest rates to battle the highest inflation in decades, led by an aggressive Federal Reserve, central bankers pivoted to address emerging weakness across major economies. Like sailors tacking a new course into turbulent headwinds, they signaled a policy shift, ready to start cutting rates to stimulate growth. At the center was Jerome Powell, the scholar-turned-central banker now guiding the Fed's course. In prepared remarks that carried the weight of ancient texts, Powell affirmed, "The time has come for policy to adjust." It was a subtle decree, spoken in the measured cadence that has characterized his tenure, yet one that amounted to an unambiguous call for lowering rates when the Fed's Open Market Committee next convenes in September. His signal removed a veil of uncertainty that had gripped markets. Investors could now bank on a pivot from the Fed, with its global counterparts poised to follow in symphonic policy coordination. Yet much remains opaque about the path forward. How quickly and deeply rates will be cut over the coming months as economic realities evolve. For Powell is navigating perilous seas. The pandemic recovery has given way to uneven growth and labor market strains. The Fed chair made clear that resilient employment, not just tamed inflation, is now the lodestar for policy. A rising unemployment rate, which hit a 3-year high of 4.3% in recent months, raised alarms in Jackson Hole. "We will do everything we can to support a strong labor market as we make further progress toward price stability," Powell intoned, his voice carrying an almost spiritual reverence for the dignity of work. He added later, "We wouldn't welcome any further increases in the unemployment rate." Around him, his counterparts from the European Central Bank, Bank of England, and others echoed the call to arms. The battle lines had shifted from vanquishing inflationary dragons to shoring up economies still healing from the pandemic's shocks. The ECB officials in attendance formed a chorus backing another rate cut in September after taking the landmark step in July. Finland's Olli Rehn described euro area disinflation as on track, while warning of subdued manufacturing and growth, comments that enforced the case for a rate cut. Portugal's Centeno deemed a move in less than 3 weeks as virtually preordained given the data signs. Underpinning their rhetoric is a profound pivot in priorities. Where inflation had been the obsession, focus has shifted to safeguarding growth and employment from stagnating amid signs of softening in factory output and hiring. Shades of the post-2008 malaise seemed to haunt the Alpine valleys. The consensus appeared to be 2 more cuts for the ECB this year if disinflationary forces persist as projected. The Bank of England cheekily signaled openness to joining the fray, with Governor Andrew Bailey saying risks of persistent inflation look to be waning. Around the world, the dominoes of easier money are lining up, with Canada, New Zealand, and China already easing while Japan stands apart, defiantly tightening for the first time in nearly 2 decades. Yet as overwhelming as the tide seems, uncertainties swirled about the depths of the coming cuts and the crosscurrents policymakers must navigate. Powell openly acknowledged the way forward remains cloudy, with the timing and pace of rate cuts to be judged against a steady stream of incoming data. In many ways, the symposium elevated as many questions as it answered. With each economy and region facing distinct challenges, how synchronized can this new coordinated campaign truly be? How aggressively must rates come down? And at what point do deeper cuts risk reigniting the inflationary flare-ups of the recent past? Some, like the Atlanta Fed's Raphael Bostic, seem to leave the door open to much larger cuts if unemployment spikes higher. Research presented warned the U.S. job market may be approaching a tipping point, with even modest further slowing carrying risks of sizable joblessness. For Powell and his counterparts, the coming months will require deft navigation through these uncharted waters. Policy must be recalibrated based on each new economic reading, a constant rebalancing act as threats shift from inflation to stagnation and back again. In his studied remarks, Powell urged not just reliance on hard data, but an evolving outlook and careful assessment of the balance of risks. The path of policy, he seemed to say, will be more art than science, the product of deep analysis and constant vigilance. As the thin mountain air whipped through the pines, one could sense the gravity of the task ahead. Central bankers must deftly wield their tools to sustain the economic expansion and preserve those most vulnerable to its ebb and flow, the workers and middle-class families who have only recently tasted the fruits of recovery. For beneath the veneer of mathematical models and econometric projections, the true struggle is one of immense human dimension. An entire generation has now come of age knowing only economic insecurity, their formative years shaped by the Great Recession, the pandemic's shocks, and now the threat of further retrenchment. In confronting these challenges head-on, policymakers display a faith that rigorous analysis and sound monetary stewardship can guide economies clear of the abyss. If the current course can be held steady through skillful economic navigation, perhaps renewal may yet emerge from the clouds now gathering. In this annual Woodstock of finance, the overtures have been sung and battle lines redrawn. Central bankers have dusted off their rate-cutting artillery to wage a new campaign supporting growth and employment. The road ahead will be long and arduous, but they march in lockstep, guided by their data streams and the wisdom of the ages to help steer the global economy clear of stagnation's depths. Their success or failure may well shape the trajectory of the world economy for a generation. For now, at least, they move forward into the tempest, resolved to fight on.